The retirement lie. Why Gen Z will pay for boomers' golden years. The deposit hits at 9:01 a.m. By 9:03, rent drafts. Health insurance pulls its cut. Groceries, student loans, gas. What's left looks fine until the payroll taxes settle. Social Security, Medicare, unemployment. Money you'll never see again, funding someone else's present. You're told it's your future too. Meanwhile, the clock ticks toward a year when checks get trimmed and the trust fund turns into IOUs redeemed with more taxes or more debt. Nobody asks your vote on that. We're going to follow the money, who pays when it breaks, and how it lands on your paycheck. The setup lie. Pay as you go, not savings. To understand the squeeze, we need to go back to the moment the promise was designed. Social Security wasn't built as a personal savings plan. It was built as a transfer system. Today's workers fund today's retirees. Your contributions don't go into an account with your name on it. They flow out immediately to someone already retired, with a promise that the next generation will do the same for you. In the early years, that model looked generous. There were many workers for each retiree. People retired later and didn't live as long after retirement. A single payroll tax rate could cover checks and still leave the system looking healthy. Early retirees received far more than they contributed because the system was young and the pipeline was wide. Politically, it was a winner. Steady checks for grandparents, small deductions for grandkids. Then the math began to shift. Fertility rates fell. Life expectancy rose. People left the workforce earlier, often with pensions that encouraged earlier exits. Instead of 5 or more workers supporting a single retiree, the ratio headed toward 3, then below. The same pay-as-you-go structure now required each worker to carry more of the load. There wasn't a catastrophe, just a slow demographic turn that made yesterday's promises heavier on today's shoulders. To smooth the bumps, Congress added the trust fund. Payroll taxes were raised above immediate needs to build a cushion. On paper, it looked like saving. In practice, the trust fund holds special treasury obligations, claims on future taxes or borrowing. During surplus years, the system effectively lent money to the rest of the government, collecting interest that would later be paid back by taxpayers. The optics, a lockbox. The reality, an IOU drawer. For a while, that worked. The surplus years masked the trend. Benefit formulas grew more generous, and cost of living adjustments indexed payments to inflation. The baby boom generation, massive in size, moved steadily closer to retirement. Meanwhile, the workforce changed. More service jobs, more gig work with irregular contributions, and periodic recessions that cut payroll tax inflows right when expenses climbed. The promise stayed the same, the base funding it thinned out. Every pay cycle, the bet continued. As long as enough workers pay in, retirees get paid. But the transition from surplus to shortfall was inevitable. Once the system needs to redeem the trust fund securities to keep paying full benefits, the Treasury must find cash by taxing more, cutting elsewhere, or borrowing more. The interest the trust fund earns doesn't come from a pile of invested assets. It comes from the same national wallet, yours, your employers, and future taxpayers. Here's why that matters emotionally, not just numerically. When you hear you earn these benefits, it sounds like your money is compounding in your name. It isn't. You paid for someone else's benefits, and future workers are expected to pay for yours. That's a social contract, not a personal account. Social contracts can hold, but they rely on ratios: enough workers, enough wages, enough compliance. When any one of those weakens, tension spreads. Higher taxes, later retirements, or quieter cuts through inflation. Meanwhile, the promise expanded beyond Social Security. Medicare grew, with parts funded by payroll taxes and parts by general revenue. Health costs rose faster than wages. The retiree benefit set turned from a monthly check into a bundle of medical commitments with price tags that don't sit still. The old idea, I pay in, I get out, now depended on forces no individual controls: fertility, immigration, labor force participation, healthcare inflation, and political will. People felt the shift without seeing it. Employers froze corporate pensions. Public pensions leaned on optimistic return assumptions to keep contributions down. Families faced higher healthcare premiums while payroll taxes stayed high. Younger workers were told to save more on their own, 401ks, IRAs, while still paying into the transfer system. The implicit message: cover your elders and self-fund your future. What nobody knew at the time or at least didn't say aloud, was how quickly the drawdown years would arrive once boomers retired in waves. The trust fund was always a timing device, not true savings. It pushed the hard choices into the moment when benefits outpaced payroll inflows. That moment is here, and the clock on full benefits is visible. The day the securities are exhausted, by law, payments can only match incoming taxes. That's a cut. Not a default, but a haircut many won't expect until it shows up in their mailbox. This was the moment everything changed. The story stops being about a program and starts being about your paycheck. If more must be collected to keep promises, it comes from wages now. If less is paid out, it's your expected future. If we borrow the gap, inflation and interest costs feed back into your living expenses and your mortgage rate. The setup lie isn't malicious, it's structural. We called a transfer a savings plan. We taught generations to see deductions as deposits. The truth is simpler and harder. It's a bill due every pay period, priced by demographics and policy, and it's accelerating toward the people working today. The ratio that broke the math. While that structural truth is settling in, look at the one number that quietly dictates everything. How many workers stand behind each retiree's check? In the 1960s, it was more than 5. A big, humming factory floor could carry a modest set of grandparents. Today, we hover closer to around 3, drifting down. That slide isn't abstract. It's the difference between a light backpack and a loaded rucksack on every paycheck. 3 things pushed the ratio down. First, fertility fell. Families got smaller, delayed kids, or had none at all. That means fewer future workers entering the payroll stream. Second, people live longer. Good news for families, tough for pay-as-you-go math. Checks go out for more years. Third, labor force participation changed. More schooling years, more caregiving years, and more workers cycling in and out of jobs. When fewer people work steady W-2 jobs, the payroll river thins. Meanwhile, the boomer wave didn't retire all at once. It arrived like a tide, crest after crest. Each year, another slice crosses the threshold. The cohorts replacing them are smaller. Even when the economy is solid, the inflow can't match the outflow unless wage growth and participation spike together. Immigration helps, but it's volatile and political. If policy brings in workers, the ratio steadies. If it stalls or skews older, the ratio sinks. Here's where it gets practical. The payroll tax is a simple lever. If there are fewer hands, each hand pays more. That can happen directly, higher tax rates or lifting the cap, or indirectly, through employers who pass their portion into slower wage growth or higher prices. You feel it either way. 0.1% here, a percentage point there, stretched over your early compounding years, becomes a larger mortgage delay or a smaller down payment. Now add the modern work mix. Traditional W-2 jobs remit payroll taxes every pay period like clockwork. But the rise of gig and contract work complicates the inflow. Quarterly estimates get missed. Irregular income leads to underwithholding. Compliance gaps widen. The system was built for steady paychecks. The labor market shifted toward volatility. Even with honest intentions, the timing of contributions becomes lumpier, just as benefit obligations become smoother and heavier. From their perspective, retirees aren't gaming anything. They played by the rules presented to them, paid in, and planned around a promise stream. From your perspective, you're covering people you love and millions you'll never meet through a formula that doesn't flex with your rent or your childcare bill. That tension isn't moral, it's arithmetic. Fewer workers per retiree means more dollars per worker unless benefits shrink. Let's walk into a kitchen in Milwaukee. A 27-year-old assistant manager, $58,000 a year, just moved into a one-bedroom. She didn't know her grandfather worked construction in the 70s. She never met her grandmother on her dad's side. But her pay stub carries them both, and millions like them. After FICA, after Medicare, after premiums, she transfers $300 to savings and wonders if that's irresponsible or brave. She keeps hearing the system might cut benefits by a quarter in about a decade. She's paying for the promise and pricing in a haircut on the promise to her. What nobody knew at the time, when the ratio first dipped under 4-to-1, was how hard the burden would feel once housing and healthcare ate bigger slices of take-home pay. In the 60s, the average worker's support for a retiree was distributed across a broad base. Today, the base is thinner and the non-negotiable expenses are thicker. The same percentage takes a bigger bite out of the life people are trying to build. Meanwhile, something else is happening. Participation among prime-age men never fully recovered to mid-century levels, and participation among prime-age women, after remarkable gains, flattened under the weight of childcare costs and fragile schedules. Each 0.1% missing from the workforce edges the ratio lower. We don't see it on the evening news. We feel it on the second page of a pay stub. This was the moment everything changed. Past a certain ratio, tweaks don't bridge the gap. The system either takes more from each worker or pays less to each retiree. There aren't many levers. Immigration policy can tilt the math if it welcomes more young workers. Productivity growth can help if it pushes wages higher across the taxable base. But those are slow levers, and the retiree wave is immediate and steady. In the aftermath, politics wraps the ratio in messages about fairness and earned rights. That matters, but the check still clears only if money arrives from somewhere. When you hear debates about lifting the wage cap or adding a new payroll tier, translate it into ratio speak. If the headcount can't rise enough, the dollars per head must. If resistance to higher taxes holds, benefit formulas will shift. Either way, the ratio calls the tune. And that leads to the next question you're already asking. If the ratio is this tight, what about the cushion everyone talks about, the trust fund? What's in it? How does it pay? And who ultimately supplies the cash when it's redeemed? The answer is more uncomfortable than the marketing suggested. The trust fund is IOUs, not cash. If the ratio is tightening, what about that cushion everyone keeps pointing to? The trust fund. Here's the plain version. Social Security's trust fund doesn't hold cash in a vault or a portfolio of private assets. It holds special issue Treasury securities created for this purpose. They're promises from one arm of the government to another. They earn interest on paper, but when the time comes to pay benefits, the only way to turn those promises into dollars is for the Treasury to raise taxes, cut other spending, or borrow from the public. What nobody knew at the time, when lockbox became a slogan, was how that language would camouflage the mechanics. In surplus years, payroll taxes exceeded benefits. Social Security used the extra to acquire those special treasuries. The rest of the government used the cash to fund other priorities. When benefits outstrip payroll taxes, Social Security redeems the securities. The Treasury then has to produce money by collecting more, spending less elsewhere, or issuing new debt. The trust fund is real as an accounting claim. It isn't a stash insulated from the broader budget. Now remember, interest accrues on these securities. That looks like growth. But that interest is paid by the same Treasury, which means it's funded by current taxpayers or new borrowing. It's circular. You can't escape the national wallet. Think of it like writing yourself a note and then celebrating that you're richer. The note matters legally. It doesn't add a second wallet to the kitchen counter. As the boomer retirements ramped up, the trust fund shifted from accumulation to drawdown. That's the phase we're entering. While it holds, full scheduled benefits can still be paid because redemptions fill the gap between payroll inflows and promised outflows. But there's a date on the calendar when the last of those special treasuries will be redeemed. The exact year moves with the economy, but the window, roughly in the early to mid-2030s, keeps coming into focus. Past that point, by law, benefits can only match incoming payroll taxes. That's the automatic cut. No congressional vote required. Meanwhile, this accounting setup creates a strange political theater. On paper, trustees can say the system is solvent so long as the trust fund balance remains. In practice, every redemption forces choices elsewhere in the budget. When the Treasury covers those redemptions, it may crowd out other spending or push borrowing higher. You won't see that on your pay stub, but you'll feel it in broader fiscal pressure, tax debates, interest costs, inflation risk if deficits meet a loose monetary stance. Here's where it becomes personal. When you hear that interest on the trust fund protects benefits, ask who pays that interest. It's you, your employer, and future taxpayers in some mix. When you hear that redeeming securities is routine, and it is, translated, routine means the Treasury must show up with cash on demand. In good times, that's manageable. In recessions, payroll taxes dip just as redemptions need to rise. The buffer helps, but it can't erase the cycle. Let's drop into a micro-story. A small business owner in Phoenix sees a headline, "Trust fund interest credited at billions this year." He wonders if that lowers his payroll tax bill. It doesn't. He still splits the 12.4% Social Security tax with his employees if they're W-2. If they're on 1099, they shoulder both halves. When benefits exceed inflows, redemptions tick up, and the Treasury's search for cash continues. His world doesn't change because a ledger entry accrued interest. It changes when Congress adjusts. Rates, caps, or formulas, or when deficits influence borrowing costs that hit his credit line. There's another wrinkle. The trust fund can't invest in equities or private assets by statute. That restriction avoids political meddling in markets, but it also means the fund never captured equity risk premiums that long-term savers rely on. It grew by collecting surpluses and interest from treasuries only. That choice kept it safe, yet tethered it to the same taxpayer base that ultimately funds everything else. Critics call the trust fund a fiction. That's too strong. It's a legal claim with real priority. The Social Security Administration can present its securities and receive payment. The fiction is thinking that payment doesn't affect you. Every dollar redeemed is a dollar the Treasury must source. If it borrows, debt rises. If it taxes, take-home pay shrinks. If it cuts elsewhere, other services give way. The trust fund spreads timing over decades. It doesn't eliminate the bill. In the aftermath of each trustee report, watch the language. Solvent until X buys political time. Depletion sounds like a cliff, but it's a formula snapback. Benefits align with payroll receipts if nothing changes. Something always changes. Deals arrive late, rate tweaks phase in quietly, caps lift, retirement ages edge up. The trust fund's existence gives lawmakers cover to delay hard votes. The delay shifts more of the fix onto younger cohorts because phase-ins hit future earners. So when someone says, "Don't worry, there's a trust fund," ask a simpler question. Who brings the cash when those bonds mature? The answer loops back to you and your peers. That's why pensions with real assets feel different. They may be underfunded, but at least they hold market securities that can be sold. Public systems often assume high returns that may not materialize, creating their own gaps. Which brings us to a harder truth. If the Social Security cushion is an IOU to taxpayers, and many pensions are stretched, the safety nets stack, and the strain compounds. We leave the ledger and walk into promises that live on the same balance sheet. Pension promises underwater. While the trust fund leans on taxpayers, another layer of promises is slipping below the surface. Pensions. They were supposed to be the solid ground. Checks backed by decades of contributions and careful investing. But the ground has shifted. Public funds often assume returns around 7% to keep required contributions politically palatable. Markets don't move on municipal schedules. When reality undershoots those assumptions, the gap doesn't vanish. It compounds. Here's the quiet mechanism. A pension's liability, the promise to pay retirees for life, is discounted back to today using an assumed rate of return. Raise the assumption, and the liability shrinks on paper. Lower it, and the promised mountain looks taller. Many plans keep the assumption high, sometimes justified by long horizons, sometimes to avoid asking cities and states for more cash now. Smoothing rules spread losses over years. It takes the sting out of bad markets, but can hide the wound until it's deep. Corporate America saw this coming and moved. Many big companies froze defined benefit plans in the 200s and 201s, shifting workers to 401ks. That doesn't erase promises already earned. It stops new accruals from adding weight. The Pension Benefit Guaranty Corporation stands behind private plans that fail, but its coverage has limits. If a plan collapses, benefits can be cut to PBGC caps. That's a safety net with a height limit, not a parachute that fits everyone. Public pensions are a different story. Teachers, firefighters, city workers, millions rely on state and local systems. These funds can't be backstopped by PBGC. They rely on contributions from governments and investment returns. When markets lag or costs rise, elected officials face two choices: raise contributions, meaning higher taxes or service cuts, or tilt assumptions to keep budgets stable. Many try a bit of both, buying time while the gap quietly grows. Walk into a city council budget meeting in late spring. Pension contributions come up. The finance director proposes an increase to keep the plan on track. Someone asks what gets cut. Library hours? Road resurfacing? The room cools. A compromise follows. A smaller increase and a promise to revisit next year, plus a decision to keep the return assumption steady. On paper, funding looks acceptable. In real terms, the plan still leans on tomorrow. There are case studies everywhere. States wrestle with billions in unfunded liabilities. Some raise employee contribution rates. Some reduce cost of living adjustments, COLAs, for retirees, not always legally simple. Others stretch out amortization schedules, lowering the annual bill but lengthening the mortgage on the promise. Each tactic delays pain. Each shifts more risk onto younger taxpayers who didn't make the original promises but will finance the repair. Discount rates aren't the only lever. Asset mixes have crept into riskier territory. To hit return targets, funds add private equity, real estate, hedge funds, assets with opaque pricing and long lockups. They can deliver, but they also blur transparency. In a downturn, stable valuations can lag reality, smoothing losses just when decisions should sharpen. The reported funded status looks better than the economic one. Meanwhile, benefit checks still go out every month. When a plan falls short, who pays? Residents, through higher taxes and fees. Workers, through increased contributions that cut take-home pay. Retirees, through COLA trims or new formulas on future accruals. Or everyone, through service cuts that reduce the value of living in the community. Sometimes it's all of the above. The payroll you saw in Social Security repeats at the local level. The bill chases whoever has cash flow. Listen to a public school teacher at 59. She's been promised a defined benefit, calculates her years, and plans to help her daughter with childcare when she retires. Then the district announces a COLA change to stabilize the plan. It's a few percentage points she won't see each year. That sounds small. Over a decade, it erodes the cushion she counted on. She'll keep working part-time. Her daughter will rethink daycare. A formula adjustment ripples through a family. From a small business owner's perspective, the pension story shows up as a property tax hike, a new municipal fee, or slower permits because the city trimmed staff. He isn't in the plan. He's funding it anyway. Add Social Security and Medicare payroll taxes, and the combined load decides whether he hires a second employee this year or waits. The pension gap becomes a hiring gap. Here's the connective tissue to Social Security. Both systems depend on return assumptions, explicitly for pensions, implicitly for payroll growth. Both use smoothing to manage optics. Both push tough choices into the future. And both, when reality intrudes, harvest from the same field, current workers and current taxpayers. Stack them, and the burden grows heavier where paychecks are still developing. The hard part isn't villainy, it's math plus time. Promises were made honestly. Life got longer. Markets zigzagged. Budgets tightened. The way out is straightforward and painful. More contributed sooner, more realistic assumptions, and guardrails on benefits that prevent runaway costs. The longer we wait, the fewer gentle options remain. And even if we make perfect decisions for pensions, a larger force is bearing down. It's the program that turns routine illnesses into fiscal avalanches. Medicare steps into frame. The Medicare elephant in the room. While pensions wobble and Social Security leans on IOUs, Medicare quietly eats the biggest slice of the pie. It has multiple parts with different funding streams, and each one pulls from a different pocket you live out of. Part A, hospital insurance, is financed by a payroll tax like Social Security. Parts B and D, physician services and prescription drugs, draw mostly from general revenue with premiums layered on top. Translation: even if your paycheck isn't directly tagged Medicare, the program still reaches you through taxes, premiums, and the price level of everything else government buys or borrows for. Start with Part A. It has a trust fund too, the HI Trust Fund, fed by that 1.45% payroll tax from you and 1.45% from your employer, with an extra 0.9% for high earners. When hospital costs outpace those inflows, the trust fund shrinks. Trustees have circled a depletion window in the early 2030s more than once, extending or compressing it as the economy and spending shift. When it depletes, the law doesn't shut hospitals. It forces payments to match revenues, which means automatic reductions to providers unless Congress intervenes. Cuts to providers ripple into access, wait times, and which services survive in thin-margin hospitals. Now look at Parts B and D. They don't go broke because they're not funded by a fixed payroll stream. They reset every year. About a quarter of their cost is paid by beneficiary premiums. The rest comes from general revenue. When healthcare costs accelerate, and they have for decades, the required general revenue grows. That money doesn't fall from the sky. It competes with everything else: defense, education, infrastructure, and interest on the debt. If deficits fill the gap, interest costs mount. If taxes rise, take-home pay falls. That's the crowd out people feel without seeing the Medicare logo on their pay stub. Healthcare costs don't move like groceries. They rise faster than GDP more often than not, driven by technology, utilization, and prices insulated from normal market pressure. Aging adds a volume effect. More people hitting the age where they use more care. An 82-year-old has a different pattern of hospital days, scans, and prescriptions than a 42-year-old. When a large cohort crosses into Medicare, the utilization curve rises across the board. You can't fight that with slogans. It's biology scaled by policy. To manage the bill, Medicare has leaned on means testing. Higher-income retirees pay larger premiums for Parts B and D through IRMA surcharges. That sounds targeted, but the thresholds can drag more people in over time if they don't rise as fast as incomes. Younger workers also pay indirectly. General revenue comes from broader taxes. If bracket thresholds don't keep pace with inflation and wage growth, more middle earners drift into higher effective tax rates. That's another quiet reach into the wallet to fund care delivered to someone else today. And to yourself someday, if you ever get there. Here's a living room in Columbus. A 63-year-old self-employed contractor stares at his marketplace premium and counts months to Medicare. His 28-year-old daughter, a nurse, is paying down loans and paying her share of payroll taxes. When he hits 65, his premium for Part B looks manageable, until he sees IRMA because of a good earning year 2 years back. She's still paying the payroll tax, and her federal tax bill nudges up because general revenue keeps inching higher to cover Medicare's growth. They're both paying. The timing is different, the bill is shared. Meanwhile, providers face a subtle squeeze. Medicare sets rates. When budgets tighten or projections slip, policymakers lean on lower reimbursement growth or cuts to certain services. Hospitals accept the payer mix because they must, but they try to make it back elsewhere. Higher charges to private insurers, facility fees, mergers to gain pricing power. That rolls back to workers through higher premiums and deductibles. The system pays with one hand and takes with the other. Your raise disappears into the family plan at open enrollment. If Social Security were the only program under pressure, we'd be arguing over a percentage point of payroll tax or a tweak to the retirement age. Medicare turns the debate into a structural fiscal question. General revenue reliance means Medicare's growth becomes the federal budget's growth engine. Layer interest costs on top if deficits carry the weight, and you get a flywheel. Healthcare up, borrowing up, interest up, crowd out up. This was the moment everything changed. Fixing Social Security without addressing Medicare solves the smaller problem and leaves the bigger driver untouched. Policymakers know it. That's why you hear about value-based care, drug price negotiations, and shifting more responsibility to Medicare Advantage plans. Some changes help bend the curve. Others move costs around the chessboard. None erase the underlying math. That an older society with expensive care needs steady money from a smaller working base. So even if Congress stages a last-minute rescue for Social Security, don't exhale yet. Medicare is the elephant. It doesn't knock at your door. It expands your tax base, trims your raises through premiums, and leans on debt you'll service for decades. To understand the next set of choices, tax hikes, benefit trims, or inflation, we have to hold this picture in view. Because every path we'll walk from here passes through Medicare's waiting room. The three doors: raise taxes, cut benefits, inflate away. Everything we've laid out funnels into three choices. Lawmakers dress them up with new names, but the mechanics don't change. You can take more money now. You can promise less later. Or you can pay with cheaper dollars. Raise taxes, cut benefits, inflate away. There's a fourth option only on cable panels: pretend. That isn't a door, it's a wall you hit when the math arrives. Door A is the cleanest to explain and the quickest to feel. Payroll rates go up, the wage cap rises, or both. You see it on your stub next pay period. The combined Social Security payroll rate, now 12.4% split between you and your employer, can move a notch. Maybe it's 1 point over a few years. Maybe it's more. Lawmakers prefer phase-ins. They count on you adapting to smaller jumps. The employer share still hits you through slower wage growth, fewer hires, or higher prices. Meanwhile, lifting the cap, currently applied up to a set wage ceiling, pulls more from higher earners, especially upper-middle professionals in high-cost cities. The immediate effect: lighter checks. The long effect: less compounding during your best saving years. A raise diverted at 28 costs you more lifetime wealth than the same dollars at 58. Dorby is quieter on day one, but heavy over decades. Change the rules of eligibility and the formulas beneath the check. Raise the full retirement age a year or two. Tweak the cost of living adjustment so it grows slower than your grocery bill. Shift bend points in the benefit formula to tilt away from higher earners. Add means testing that phases down benefits for people who saved outside the system. On paper, nobody's cut, just reformed. In reality, your expected stream shrinks. The politics of Dorby are tricky because retirees are organized and vote. That means changes tilt toward future beneficiaries. Younger workers feel most of the trim. You won't see a bill in the mail. You'll see a later retirement date, a smaller monthly number than your statement implied, and a tax surprise if your outside savings make you too successful for full benefits. Dorsey rarely gets a roll call vote. It arrives through budgets and central banks. Borrow to fill the gap. If buyers absorb the debt without pushing rates up, you push the fix forward. If the central bank steps in when markets wobble, money conditions loosen. Inflation does the rest. Prices rise, wages follow unevenly, and the value of a fixed benefit, indexed imperfectly, erodes. Tax brackets adjust with a lag or not at all, pulling more of your raise into higher effective rates. You pay without a headline saying so. Savers lose purchasing power unless they own assets that outrun inflation. Debtors get relief in real terms. Governments like Dorsey because it spreads pain and hides it. The risk: you play too long and damage credibility. Then inflation becomes a politics-economics tug-of-war with whiplash policy and higher risk premiums. None of these doors are pure. The likely path is a hybrid because coalitions are messy and timelines are short. A small payroll bump here, a cap lift there. A retirement age nudge paired with a softer COLA. Borrowing that expands in downturns and shrinks on paper during recoveries. Each piece is calibrated to reduce headlines and extend careers. That hybrid leans on younger cohorts most because phase-ins start now and bite later, while borrowing costs stack interest that your working years will service. Now stakes. Dore shifts the load to current workers immediately, especially those in their prime saving window. It dampens wealth building when it's most powerful. Dorby shifts the load to future retirees, mostly today's younger workers, by reducing what they'll receive or pushing it later. It forces more private saving under uncertainty. Dorsey taxes everyone through the price level, but hits wage earners and cash savers hardest. Asset owners with pricing power can outrun it for a while. Renters and fixed-income households can't. Here's where it gets specific. A 30-year-old software engineer sees a cap lift that grabs more of her marginal dollar. Her 50-year-old manager sees a slower COLA projected into his retirement estimate. Their HR team watches premiums climb as providers shift costs from Medicare cuts. Meanwhile, a recession hits, deficits widen, and inflation reaccelerates just as the central bank hesitates between taming prices and stabilizing jobs. That's the hybrid in a single office floor. What nobody knew at the time, when prior reforms phased in, was how sticky temporary changes become. Bracket creep hangs around. Age thresholds rise again. One-time payroll surcharges outlive the press release. Once a lever proves passable, it's used. That's not cynicism, it's institutional memory. There's also the fairness trap. Every door can be framed as fair. Tax the top because they can pay. Cut benefits for those who don't need it. Inflate together because shared sacrifice. Each argument holds some truth and misses the core. The bill is driven by demographics and health costs, not moral failings. Design matters, but the weight has to land. The only counterweight is growth, more workers, more productivity, more taxable wages, plus healthcare reforms that buy value instead of volume. Even then, you don't escape the doors, you just make them smaller. And smaller doors are still doors you have to walk through. Door A, the millennial tax. While that hybrid hangs over everything, Door A is the one you'll feel first, no speech is needed. The rate ticks up, the ceiling lifts, and your paycheck shrinks the same week. Policymakers call it a contribution. You'll call it a delay. The apartment you don't move into, the car you keep one more year, the savings rate you meant to raise and didn't. Start with the rate. Social Security's combined payroll tax sits at 12.4%, split between you and your employer. Raise it by half a point over a few years, and the numbers look gentle in a committee hearing. On your stub, not so gentle. Every step lands on dollars that would have compounded during your best investing years. A dollar at 28 isn't the same as a dollar at 58. The younger you are, the more that diverted dollar costs your future. Now consider the cap. Each year there's a wage ceiling where Social Security stops taking its cut. Lifting it, whether to a higher number or removing it above a new bracket, targets upper-middle earners first. Engineers, nurses in overtime, dual-income households in expensive cities. They aren't rich in the caricatured sense. They're the people maxing 401k, as if they can, paying daycare and rent that act like a second mortgage. A higher cap pulls more of their marginal dollar into the system. It doesn't show up as a tax hike headline for them. It shows up as a budget that never quite closes. Here's the pass-through nobody votes on. The employer half of the payroll tax isn't free money from a faceless company. In tight labor markets, it suppresses wages. In loose ones, it trims hiring. It can raise prices at the margin. However it travels, it lands back on workers and customers. A restaurant owner looks at a payroll hike and decides not to add a second prep cook. Wait times get longer. The Saturday shift works later. Everyone thinks they avoided a tax. They paid with time. Phase-ins are the classic tactic. 0.1% this year, another next year. By the time it totals 1 percentage point, most people have adapted. But adaptation has a cost. You save a little less. You carry a credit card balance 1 month longer. You delay student loan prepayments. Those micro delays add up to a quieter, larger bill in your 40s when compounding would have been doing the heavy lifting for you. Bracket creep compounds the problem. If wage growth pushes you into higher tax brackets faster than thresholds adjust, your effective tax rate climbs even without a vote. Layer a payroll increase on top, and the staircase steepens. It feels like you're running harder and staying in place. That feeling is the policy, not your imagination. Let's run a micro-story. A 31-year-old physical therapist in Denver makes $86,000. She started a Roth IRA at 25, nudged to 10% savings 2 years ago, and just got a $4,000 raise. A payroll rate bump and a higher cap absorbed $1,200 of that raise. Her health plan premium rose, too. She keeps her savings rate flat because rent jumped. Nothing so dramatic happened that she could point to it. Dora just walked through her budget and rearranged the furniture. Now from the employer side. A 12-person design firm in Raleigh pays both halves for 2 co-founders on payroll and the employer half for everyone else. When the rate rises, the owners skip their own raises and delay hiring a junior designer. They push a contract role instead. No payroll taxes on their side for a 1099. The work gets done. The pipeline into stable W-2 jobs shrinks a little. Dora interacts with the gig economy in ways that reinforce volatility. If you're in your 20s or 30s, Dora steals compounding years. The early dollars buy the most future. A 1-point payroll increase feels modest until you stretch it across decades of foregone market growth. If you're in your 50s, Dora can still bite, especially if the cap lifts, but you've already banked more of your compounding. That's why this door tilts toward the young, even when rhetoric says shared. Burden. There's a fairness argument for Dora. The program is universal. The funding should be universal and adequate. That's coherent. The problem is timing. We're layering higher contributions onto generations already carrying higher housing costs, childcare bills, student debt, and volatile healthcare premiums. The capacity to absorb new deductions is there on paper. It's thinner in real life. What nobody saw in the talking points was the feedback loop. Higher payroll taxes slow entry-level hiring at the margin. Slower hiring delays wage ladders. Delayed ladders reduce lifetime earnings. Reduced earnings shrink future payroll inflows. Dora tries to outrun its own shadow. Now, none of this means Dora is avoidable. If benefits won't be cut deeply and inflation is politically toxic, raising more money is the lever with the least friction. But if we pull it, we should do it with eyes open. Phase-ins that start later reduce harm to compounding. Pairing with childcare policies can lift participation and offset the drag, and guardrails should prevent temporary surcharges from aging into permanence. Because once Dora is open, it tends to stay ajar. And when taxes start to stall growth, the political conversation slides toward fairness through cuts. Door B waiting in the hallway. Door B, the moving goalposts. If Door A grabs your paycheck today, Door B reaches into your future and moves where the finish line sits. It doesn't feel like a bill. It feels like a rule change. You train for 26 miles. At mile 24, the course director adds 2 more. You still get a medal. It just takes longer, and you're more tired when you cross. Start with the full retirement age. When Social Security began, people claimed later and lived fewer years after. As longevity rose, lawmakers in 1983 nudged the age up from 65 to 67 over decades. That playbook is still on the table. Add months, then years, phased in by birth cohort. On cable news, it sounds neat. People live longer, so we work longer. In a hospital ward, a 63-year-old nurse with a torn rotator cuff hears that has 2 more years on night shift. In a warehouse, a 58-year-old picker with a sore back hears it as pain. The rule is uniform, bodies aren't. Then come formula tweaks that don't announce themselves. Cost of living adjustments, COLAs, can be shaved by changing the index. Use a measure that grows slower than your real basket, and the gap widens over a lifetime. It starts with a few dollars the first year. 10 years in, it's rent. 20 years in, it's groceries. Bend points in the benefit formula can also shift. The math that translates your lifetime earnings into a check can be tilted so higher lifetime earners get relatively less growth. That preserves progressivity on paper and trims outlays in practice. Means testing sounds fair. Reduce benefits for those with higher income in retirement. The catch is how income is defined and where the thresholds sit. If withdrawals from your 401k count the same as wages, savers find themselves penalized for doing what every financial planner told them to do. Set thresholds low or let them creep up slowly, and middle-class retirees get pulled in. The intent is to protect the most vulnerable. The side effect is to tax prudence twice, once when you saved, again when you draw. Politically, Door B lands where votes are soft. Current retirees have a strong voice. Near retirees watch closely. So reforms tilt toward younger cohorts who can't punish today's Congress. That means you, at 32, will absorb a higher retirement age and a slower COLA, while your parents keep current rules. It isn't malice, it's arithmetic plus elections. But it feeds mistrust. You're told the program is earned, and then the conditions change while you're paying in. There's another layer: disability and early claiming dynamics. If the full retirement age rises, some workers in physically demanding jobs will claim early at a larger penalty, locking in smaller checks for life. Others will try the disability route, shifting costs from one part of the system to another. Costs don't vanish, they migrate. Meanwhile, employers recalibrate. A construction firm sees older workers staying longer and redesigns roles, or doesn't. Either way, the friction costs land on people, not spreadsheets. Let's sit with a microstory. A 42-year-old public transit mechanic in St. Louis runs the numbers. Under current law, his full retirement age is 67. Rumors swirl that it'll rise to 68 for his cohort, with a tweak to COLA. He ups his 401k contribution by 1% and tells his wife they'll keep the second car longer. 5 years later, the reform passes phased in. He feels a quiet relief for planning ahead and an irritation he can't quite place, like the rules moved in the middle of the game and everyone insisted nothing meaningful changed. Door B also seeds a behavioral shift. If you think benefits may be trimmed, you save more if you can. That's good, until you hit a means test and lose part of what you primed yourself to expect. People respond by shifting savings into forms that don't count as income at claim time: Roth accounts, cash value, home equity. Policy encourages it without saying so. Complexity rises. Advice becomes a maze. Meanwhile, trust erodes. The line "you earned it" blurs when formulas change. That cynicism shows up as lower participation in voluntary retirement plans or riskier decisions, swinging for high returns to make up what policy might take. It shows up as career timing, postponing a job change that would cut current pay but raise future earnings, because today's cash feels safer than tomorrow's rules. There are smarter ways to open Door B. Announce changes early with long lead times. Shield truly low earners. Index thresholds honestly. Balance retirement age policy with investments in occupational retraining and mid-career health support. So working longer doesn't mean grinding people down. Pair COLA adjustments with targeted credits for the oldest old, who feel compounding cuts most. Make means testing transparent and modest enough not to punish baseline saving. What nobody likes to admit is that door B can be necessary. Demographics don't negotiate, but door B without trust shatters the social contract. You keep paying into a system you no longer believe in, and you withdraw from civic compromise just when shared decisions matter. If we move the goalposts, we need to show the field, the chalk, and the timer, and give people time to adjust their stride. Because if backlash builds, politics reaches for door C, the silent lever that doesn't ask permission. Door C, the hidden tax you don't vote on. When door A sparks backlash and door B risks a voter revolt, policymakers lean on the lever that doesn't need a press conference. Borrow the difference, let the central bank keep markets calm, and let inflation carry part of the weight. Nobody votes on it. You just notice that your raise disappears into prices and your savings by less than they did. Here's how it moves. The Treasury issues more debt to cover benefits and healthcare as costs outrun dedicated revenues. If buyers, pensions, banks, foreign funds absorb it at reasonable rates, the extra borrowing feels painless. If demand thins, yields rise. Then the central bank faces a choice. To steady markets or rescue growth in a downturn, it can cut rates or buy bonds, adding liquidity. Money conditions loosen. Inflation pressure rises with a lag, especially when supply is tight and labor is scarce. Inflation is a tax paid in the checkout line. It clips everyone, but not equally. Wage earners negotiate with delay. Pay bumps trail prices, then catch up unevenly. People in concentrated industries or with rare skills stay ahead. People with less bargaining power lag. Fixed benefits have cost of living adjustments, but those formulas don't capture every shift. Housing quality, insurance deductibles, shrinkflation. You keep your nominal benefit. It's real bite dulls. Bracket creep does the quiet follow-up. Tax thresholds often adjust slower than wages in an inflation year, or they miss certain credits and surtaxes. You slide into higher brackets without feeling richer. Governments collect a larger share without changing a rate. Dorsey loves that. It claims progress without a vote. Asset owners and wage earners live two different stories under inflation. If you own a business with pricing power or a rental in a tight market, you can pass through higher costs. Your equity rides the wave, sometimes faster than prices. If you live on a paycheck with little room to negotiate and your savings sit in cash, you sink. The same inflation that trims the real value of debt also trims the real value of wages and emergency funds. Now step into a split screen. On the left, a 35-year-old couple in Austin rents, carries $10,000 in savings, and plans a first home purchase in 2 years. Groceries rise 10% in a year. Rent renews up 8%. Their emergency fund, untouched, lost a month of living power. They push the home timeline back. On the right, a 62-year-old with a paid-off house and a stock-heavy portfolio watches nominal values jump. His Social Security COLA bumps his check. His property taxes climb, but slowly. Dorsey tax the couple harder. Debt dynamics add another layer. When inflation runs hot, lenders demand higher nominal rates to protect real returns. If the central bank tightens to tamp prices, borrowing costs climb everywhere. Mortgages, car loans, business lines of credit, all more expensive. That's a second channel of pain for younger households trying to buy assets. Inflation first pushes prices up and makes you chase. The response raises rates and makes the chase pricier. Here's where policy whiplash lives. To manage inflation, the central bank must slow demand. To sustain fiscal programs, politicians prefer growth and easier financing. The push-pull creates zigzags, stimulus, then restraint, rate hikes, then pause, guidance that shifts with data. Households can't plan around whiplash. They accept shorter planning horizons. They stockpile or delay. Both behaviors feed volatility. Meanwhile, a subtle narrative forms. Promises kept. Checks go out on time. Benefit formulas apply. Healthcare coverage continues. On paper, the social contract holds. In reality, the purchasing power of those promises drifts down, especially for items without perfect indexation. The appearance of stability masks a recalibration. Dorsey pays part of the bill through time and perception. Now a micro-story from a shop floor in Toledo. A 29-year-old machinist gets a 3% raise after a strong review. Gas is up 20 cents a gallon, eggs spike again, and his landlord emails about market adjustments. He increases his 401k contribution by 1% to stay disciplined, then pulls it back after 3 months because overtime dried up and utilities jumped. Nobody cut his benefit. Nobody raised his payroll rate. The hidden tax arrived in his grocery cart and his power bill. The dollar's credibility is the guardrail. If markets believe inflation will settle and debt is manageable, Dorsey can be used sparingly without lasting damage. Abuse it, and investors demand higher risk premiums. Currency weakens. Imported goods cost more. Inflation expectations unanchor. Then you're not smoothing a crisis, you're feeding it. Restoring credibility requires harsher medicine later. Deeper rate hikes, sharper spending restraint, or explicit tax increases layered on top of the inflation you already endured. There's also a distributional boomerang. Older homeowners with assets see their balance sheets inflate, then face higher insurance and maintenance costs and modest real benefit erosion. Younger renters pay through rising rents, rising rates, and delayed asset entry. Retirees on lower fixed incomes suffer because their basket, medical services, utilities, food, often inflates faster than headline measures. Dorsey claims to spare politics and ends up choosing winners and losers without a vote. It doesn't mean inflation is always a policy error. Recessions warrant support. Emergencies require cushioning. But using persistent inflation as a funding strategy is corrosive. It degrades planning, erodes trust, and teaches people to game the system rather than invest for the long term. You start hearing conversations about gold, crypto, collectibles, not because of fundamentals, but because people don't trust tomorrow's prices. There are ways to blunt Dorsey's damage. Index brackets and credits fully and transparently. Protect the oldest old with targeted supplements that account for medical inflation. Keep central bank independence credible and focus fiscal expansions on productivity, childcare capacity, housing supply, permitting reform, infrastructure that shortens supply chains. If you must borrow, borrow for investments that raise real capacity, not just for checks that stoke demand without adding supply. Here's what nobody says clearly when Dorsey is in play. It's still a choice about who pays. It taxes savers in cash, renters, and wage earners without bargaining power. It benefits debtors, owners of scarce assets, and institutions that can reprice quickly. If we're going to use it, we should say so, design around its harms, and stop pretending it's free. Because once the hidden tax takes hold, it's hard to turn off. And the longer it runs, the more it becomes the culture, short-term thinking, defensive finance, and a generation that never quite catches up. The timeline, when the music stops. While Dorsey hums in the background, calendars start to matter. Programs don't run on vibes. They run on statutes and trust fund balances that hit zero on a date that can't be wished away. The question isn't if the music stops. It's which song ends first, and what the room does when the speakers cut. Start with Social Security's old age and survivors insurance, the big check. Trustees have pointed to an early to mid-2030s window for trust fund depletion. The exact year moves, strong employment pushes it later, recessions pull it forward. But the idea is steady. Sometime around the early 2030s, absent changes, the trust fund balance hits zero. That doesn't end checks. It triggers the rule that benefits can only equal incoming payroll taxes. Translation: an across-the-board cut from scheduled levels on the order of a quarter. Not theoretical, a formula. Medicare's Hospital Insurance Trust Fund tracks a similar arc, with depletion also projected in the early 2030s give or take a few years depending on costs and payroll strength. When HI depletes, provider payments must match revenues unless Congress acts, which means automatic reductions to hospitals and skilled nursing facilities. Parts B and D don't deplete because they're funded by general revenue and premiums, but their growth puts pressure on taxes and deficits every single budget cycle. One cliff, one staircase, both moving toward the same wall. Now layer politics on that actuarial map. Congress rarely moves early. The 1983 Social Security reforms happened months from insolvency, signed in April after emergency measures kept checks going. That muscle memory encourages brinkmanship. Expect hearings, white papers, a commission or two, then a late-night vote with a package that blends tax and benefit tweaks. The closer the date, the sharper the must-pass energy. The farther the date, the easier it is to punt. Economic shocks shove the timeline. A recession slashes payroll tax inflows and raises unemployment, accelerating Social Security's drawdown and stressing Medicare as incomes fall and people shift coverage. A bull market and tight labor market do the opposite, fattening payrolls and delaying the reckoning. The window breathes with the cycle, which gives optimists cover to say, "We've got time," and gives realists heartburn because time is the one thing compounding uses against you when you delay fixes. Demographics aren't delaying. Peak boomer retirements hit in waves through the 2020s and early 2030s, then taper. Replacement cohorts are smaller. Immigration policy can widen or narrow the pipeline. A young skewed inflow buys years. A stall subtracts them. Participation among prime-age workers matters too. Every tenth of a point regained adds revenue. Every tenth lost speeds depletion. You won't see that as a headline. You'll feel it as another year shaved off the trustee projection. Meanwhile, states and cities set their own clocks. Pension amortization schedules stretch decades. When markets sag, contribution ramps kick in a few years later by design. Those ramps often coincide with federal fixes, stacking local tax increases on top of federal changes. From your vantage point, 2032 to 2036 looks like a corridor of policy toll booths. Payroll tweaks, COLA adjustments, Medicare provider debates, property tax hikes to shore up pensions, and premiums that keep edging higher. So what actually happens the year it breaks? Picture a trustee report landing in spring with a depletion date that crosses into the next presidential term. Markets sniff risk. Advocacy groups mobilize. Friends text friends. Clips go viral. Phones light up. Drafts circulate with phased payroll hikes starting next January, a lifted wage cap above a new tier, a slow retirement age nudge for those under 50, and a COLA trim via index change. Medicare's package leans on drug pricing, site-neutral payments, and a bump in IRMA surcharges. None of it is enough alone. Together, it squeaks by the actuary's test. Here's where the personal calendar intersects the national one. If you're 28 now, you'll be in your late 30s when the Social Security fix lands. That's prime family and mortgage time. A payroll bump right then steals compounding you can't get back. If you're 58, you'll likely be shielded from the harsher edges, but Medicare premium surcharges and tax shifts can still hit your high-earning years. The timeline's pain is age-specific, because phase-ins protect those closest to benefits and lean on those farthest away. Market shocks can turn corridors into choke points. A sharp downturn in 2029 would widen deficits, speed trust fund drawdowns, and force a faster, larger package under worse conditions. A productivity boom could do the opposite. More taxable wages, more breathing room, a smaller fix. Betting on booms is not a plan. Betting against recessions is worse. What nobody likes to say out loud is that the fix tends to arrive late and skew young by design. Late means changes must be bigger. Skewed means the people who can't vote the current Congress out-absorb more of the adjustment. That's the playbook because it's the path of least political pain. So the timeline isn't just dates on a chart. It's a map of when your pay, your prices, and your expectations collide with laws written decades ago. The music doesn't stop all at once. It stutters, then someone hits a new track. Higher taxes here, lower growth there, quieter inflation in between. If you know roughly when the switch flips, you can prepare. If you don't, you become the buffer that absorbs the static. How they fixed it last time, and what that tells us. 3 days earlier than anyone expected, in April 1983, Congress stared over a cliff and moved. Checks were weeks from bouncing. The rescue came as a package with clean labels and sharp edges. Raise payroll taxes, push the full retirement age from 65 towards 67 over decades, start taxing Social Security benefits for higher income retirees, and trim disability and early retirement incentives at the margins. It read like technocracy. It felt like time bought. To understand why that package worked, we need to go back to the mechanics. The commission, chaired by Alan Greenspan, built political cover. Bipartisanship spread ownership, so neither party bore all the blame. The reforms had 3 traits. First, they phased in. The retirement age rise didn't hit current retirees, barely touched near retirees, and landed squarely on younger workers who had decades to adjust on paper. Second, they broadened the base. By making benefits taxable above certain income thresholds, the program reclaimed revenue from better-off retirees without cutting their nominal checks. Third, they overcollected for a while. Payroll tax increases created surpluses that flowed into the trust fund, building the IOU cushion we now lean on. What nobody grasped in the glow of that deal was how those choices would echo. Phase-ins deferred political pain, but guaranteed that younger cohorts paid more and received proportionally less than the generation they were supporting. Taxing benefits introduced a precedent. Social Security could be both an earned benefit and taxable income. The surplus strategy solved the immediate crisis and set up today's accounting. Special treasuries piling up, then redeeming right as the boomer wave arrives. The media called it a save. Trustees issued charts that bent upward. The public heard solvent. Meanwhile, the slope of the fix leaned toward people who couldn't vote anyone out for decades. A 25-year-old in 1983 gave more, expected later, and saw part of his future benefit taxed, if his retirement income rose enough. It was the cleanest, messy solution available, and it held because the economy could absorb it. Strong growth, high labor force participation, and falling inflation through the late 80s and 90s. There were trade-offs inside the trade-offs. Raising the normal retirement age is a benefit cut by another name. It didn't touch the formula. It reduced the number of years you collect at the full rate and increased penalties for early claiming. Taxing benefits added a wedge. Save outside the system, and your success would send some of your Social Security back through the tax code. For lower earners, the package protected the floor. For middle earners, it tightened the belt invisibly. Now zoom out. What does that tell us about the next fix? Expect the same architecture with harsher edges. Deficits are larger. Debt is heavier. Healthcare costs eat a bigger share. Growth is slower and more uneven. There's less room to hide mistakes. So the likely moves rhyme. Modest payroll increases phased in, a cap lift or new tier for high wages, another nudge on the full retirement age by cohort, and more aggressive taxation of benefits for retirees with moderate to high incomes. Add a COLA index change branded as more accurate. Sprinkle drug pricing and provider payment changes to claim Medicare savings. Layer in IRMA expansions quietly. The lesson isn't just which levers they pulled, it's how they sold them. The 1983 deal framed changes as fairness and modernization. It paired pain with shared credit and clear deadlines. Today, the same playbook needs more honesty about distribution. If phase-ins hit younger workers hardest, say so and exchange it for something tangible. Childcare support that raises participation, immigration reforms that widen the worker base, training credits that help older workers shift jobs as retirement ages rise. If benefits will be taxed more, hard index the threshold so bracket creep doesn't silently expand the net. There's also a caution about relying on trust fund optics. After 1983, surpluses seemed to secure the future. They secured time. They didn't secure demographics. The trust fund was a bridge, not land on the other side. If the next package builds another bridge, bigger surpluses now, drawdowns later, tie it to automatic stabilizers. If payroll inflows underperform, rates move a tenth higher automatically. If healthcare costs beat a target, Part B premiums and provider updates adjust by formula. Don't wait for midnight votes. Listen to a senator in a closed-door meeting. We'll shield anyone over 55. That sentence carries the essential politics of reform. Protect those closest to collecting. It also explains why the young will pay again. If you're 30, you're the margin where math meets votes. The 1983 deal taught leaders that delayed pain is passable pain. Without guardrails, they'll use the same trick. There were smarter touches in 1983 worth copying. Advance notice, clear cohort tables, outreach that explained trade-offs without condescension, and a truth: the earlier you act, the gentler the slope. Today, acting early means smaller tax bumps, smaller age nudges, and fewer surprises. Acting late means a heavier blend taken faster, with markets watching and interest costs climbing. Here's the blunt takeaway. Last time, they saved the program by redefining the promise and sending the bill forward. This time, they'll redefine again. The question is whether we pair redefinition with growth and transparency, or just push the bill, once more, into the laps of the people who haven't yet had a chance to sit down. Microeconomics of a paycheck under stress. Walk into a paycheck. Line 1, gross pay. Then the carvings begin. Social Security and Medicare skim first. Federal and state income taxes take their slice. Health insurance premiums pull next, often paired with a deductible you hope you won't meet. If you're disciplined, retirement contributions come out before you can change your mind. What's left is take-home: rent, groceries, transit, childcare, debt, and whatever future you can still buy. Start with payroll taxes. At 12.4% for Social Security. Split with your employer if you're W-2. The system collects before you see the money. Add Medicare's 2.9% split. If you're 1099, you carry both halves. That's the base toll just to step onto the road. Then health coverage. Employer plans feel cheaper because the premium is hidden in the math of your total compensation, but the out-of-pocket maximum sits like a storm cloud over your budget. One bad month can swallow a year of saving. Now add housing. In many cities, rent jumps track faster than raises. A renewal up 6% erases a careful bump in your 401k contribution. Childcare can match a mortgage. Student loans restart and move unpredictably with policy shifts. Transportation costs ride on gas, maintenance, and insurance premiums that climb with parts and labor. Each category competes with your savings line, the only line that doesn't complain if you change it. Let's compare households. A 28-year-old teacher in Minneapolis earns $55,000. Her stub shows around $4,580 gross monthly. After payroll taxes and federal state withholding, her take-home lands near $3,300. Health premiums pull $220, a modest plan with a deductible that still hurts. Rent is $1,450, utilities $160, transit $90, groceries $350, phone and internet $120, student loan $210. She auto-saves $275 into a Roth 401k. By the 25th, she has $125 left. A surprise copay or a friend's wedding pushes her to a credit card, then a payoff sprint that steals next month's savings bump. Across town, a 58-year-old operations manager makes $110,000. Gross monthly, about $9,165. Withholdings are heavier, but the mortgage from 2005 is fixed at a lower rate. Kids are launched. Health premiums are higher. Age bands aren't kind, but the HSA helps. He defers $1,600 per month to his 401k and still has room for $300 to taxable savings. Door A's payroll bump would hit him, especially if the cap lifts, but his compounding already did decades of work. The same $1 diverted from him and from her doesn't cost the same future. Inflation threads through both stories unequally. The teacher's basket, rent, food, transit, reprices quickly. The manager's biggest cost, housing, is locked. When prices run, her savings rate is the shock absorber. He flexes discretionary spend or taxable contributions. That's how macro pressure turns into different micro trade-offs, even before any formal fix arrives. Now trace how employer decisions reflect in paychecks. Health premiums rise 5%. The company covers 3, you cover 2 through a smaller raise. On paper, your merit increase hits. In your account, it didn't. A payroll tax nudge stacks on top and takes the part you thought you'd invest. HR talks cost control. You feel stasis. Compounding is where the quiet damage lives. A 2% higher total tax and premium drag at age 27 doesn't sound monumental. Over 30 years, it can mean tens of thousands less invested, translating into 6 figures less at retirement with modest return assumptions. Conversely, a 1% higher savings rate sustained from 25 to 40 can erase much of a policy drag. The catch: policy drags are mandatory. Savings bumps are voluntary and fragile under stress. Here's a micro story. A 30-year-old paramedic in Tampa decides to max a Roth IRA this year, $7,000. 6 months in, his landlord sells, and the new owner raises rent by $240. He drops his Roth auto transfer by half and promises to catch up later. The promise slips under overtime and fatigue. 2 years pass. He missed $7,000 of contributions that would have grown for 3 decades. He didn't fail. The budget did what budgets do under pressure. Insurance is the other underappreciated lever. Auto and home premiums have climbed with repair costs and weather claims. Those aren't officially taxes, but they pull from the same pool. Raise deductibles to cut premiums, and you increase the risk of one large, destabilizing bill. Keep lower deductibles, and you pay more every month. Either way, your capacity to save is the buffer. Student loans complicate the age curve. A 26-year-old nurse on an income-driven plan sees payments float with wages and policy. If thresholds aren't indexed fully, bracket creep, and loan recalculations move together, eating raises twice. A 56-year-old engineer who refinanced at a fixed rate years ago has a predictable exit date. Predictability is a hidden asset the young don't own yet. Taxes beyond payroll matter too. Property taxes rise as assessments catch up. Sales taxes creep up in city budgets under pension strain. Fees appear: vehicle registration, permits, utilities with infrastructure surcharges. You don't argue each one. You just lower a savings line again. So what can a paycheck do under stress? Automate early, before lifestyle inflates. Use buffers, an HSA if offered, a small emergency fund that lives out of sight. Diversify tax buckets so future policy can't corner you. Keep fixed costs flexible. Avoid leases and subscriptions that ratchet. Invest in earning power, licenses, skills, certifications that lift you a pay band. And anchor your budget around the truth that every new policy layer will lean first on your most optional line, the dollars you meant to invest for yourself. Building your off-ramp, personal strategy. Despair isn't a plan. If the public floor is shifting, you build your own. That starts with a simple rule you can execute on a tight paycheck. Save first, then spend. Automation is your ally because willpower loses to Thursdays. Set contributions to move on payday. 401k, IRA, HSA if you have one. So the decision is made before lifestyle can claim it. Start small if you must. 2% rises to 3, then 4. Use auto-escalation features. The goal isn't a heroic number tomorrow. It's a system that ratchets up quietly and survives bad weeks. Next, diversify your tax future. You don't know which door lawmakers open. So you want money in different buckets. Pre-tax accounts that lower today's bill, Roth accounts that grow tax-free, and a plain taxable account for flexibility. If you're early in your career and expect higher earnings later, tilt more to Roth now. Pay tax when your rate is low. If you're in your peak bracket, traditional contributions can buy valuable deduction space. Taxable accounts matter because they're your bridge money. No age rules, capital gains rates, and liquidity when life throws you a curve. Own productive assets. Over time, broad equities have outpaced inflation and wages. You don't need to find the next rocket ship. A low-cost total market index does the compounding while you work your job. If you want to add risk thoughtfully, tilt a slice towards small caps or international developed markets and keep it boring. Rebalance on a calendar, not vibes. If you can't sleep, your allocation is wrong. Add bonds for ballast as your runway shortens, short duration, high quality first, then adjust. Avoid chasing funds with glossy brochures. Your edge is behavior, not brilliance. Inflation defense belongs in the mix. Tips hedge purchasing power for a slice of the portfolio, especially in tax-advantaged accounts. Real assets have a role, but keep the story straight. A primary home is shelter first, investment second. If you buy for stability with a time horizon that matches a mortgage. Rental property works when you run it like a business and know your market, not because you saw a thread. Public equities with pricing power. Firms that can raise prices without losing customers also help. Don't mistake collectibles and fads for strategy. If the thesis relies on everyone else believing harder, pass. Your most important asset isn't on a statement, it's your ability to earn. Invest there deliberately. Stack certifications that move your pay band. Learn the software nobody wants to learn. Become the person who can explain the hard things simply. That translates into promotions, freer movement between firms, and insulation when your industry hits a rough patch. A side skill that throws off $500 a month covers a Roth IRA. In a Dore world, that buffer matters. Healthcare is a wealth strategy. If your employer offers a high-deductible plan with an HSA and you can carry the risk, consider it. HSAs are triple advantaged, deductible going in, tax-free growth, tax-free withdrawals for qualified expenses, and can function as a stealth retirement account if you pay current costs out of pocket and save receipts. That's not for everyone. If cash flow is tight or risk makes you queasy, a richer plan can be the right choice. The real lever is prevention. Sleep, strength, mobility, and regular checkups aren't Instagram advice. They're compounders that lower lifetime costs and extend working years. Longevity is a financial variable now. Plan for a longer runway than your parents. Delaying Social Security claiming, if the rules still reward delay when you get there, can be a powerful longevity hedge, raising your inflation-adjusted floor for as long as you live. That depends on health, work options, and a spouse's benefits. Run the numbers before the year you turn 62. For guaranteed income beyond that, be cautious. Simple, low-cost immediate annuities bought later in life can insure against living far longer than averages. Complex products with riders you don't understand are a tax on confusion. Buffers beat forecasts. Keep a real emergency fund, 3 to 6 months of essential expenses, segmented in a high-yield savings account you can't see easily. That fund keeps you from tapping retirement accounts or carrying a credit card balance when the car dies. If you own a home, a HELOC can be a secondary buffer, not a piggy bank. Store cash where it won't tempt you. The point is to survive policy and life volatility without derailing your compounding. Make fixed costs flexible. Long leases, car payments stretched to 7 years, and subscriptions that breed in the background turn your budget into concrete. If housing eats your future, house hack for a season, rent a room, split with a friend, or live near transit to ditch a car. None of this is glamorous. It's breathable. Optionality is wealth disguised as modesty. If you lead a household, run a monthly policy proofing session. 10 minutes. What changed? Taxes, premiums, payroll deductions, local fees. Adjust contributions up or down deliberately. Calendar annual tasks. Raise 401k by 1 point, shop insurance, update beneficiaries, harvest losses if markets dropped. Fill your IRA by the deadline. Small, boring rituals beat heroic bursts. Finally, align money with meaning so endurance is possible. Name what the savings buys: time with kids, freedom to change careers, care for a parent. Money is stamina. In a world where public promises stretch and shift, your off-ramp is built from habits that can function under stress, assets that outpace inflation, and skills that keep raises coming even when policy leans on your check. You won't dodge every toll, but you won't be stranded when the route changes. The Civic playbook: what to push for. You can't opt out of the system you live in, but you can shape it. Start with sunlight. Demand transparent accounting from Social Security, Medicare, and pensions, realistic discount rates, honest healthcare assumptions, and tables that show who pays by cohort. If projections miss targets, require public explanations, not footnotes. Build automatic stabilizers so fixes don't need midnight votes. If payroll inflows fall below a trigger, rates adjust a tenth automatically. If costs beat targets, COLAs or provider updates slide within guardrails. Make both directional. When the wind is at our back, relief kicks in too. Protect savers without turning means testing into a booby trap. Index thresholds to wages, exclude modest Roth withdrawals from income tests, and cap combined clawbacks so prudent households aren't punished twice. Pull workforce levers that grow the base. Expand high-skill and essential worker immigration with fast pathways tied to labor shortages. Make childcare cheaper and supply plentiful. Zoning for centers, refundable credits that phase with earnings, and streamlined licensing so prime age participation rises. Fund retraining for mid-career workers whose bodies or industries can't do another decade. Attack healthcare's price machine. Pay for outcomes, not visits. Push site-neutral payments so a hospital logo doesn't triple a bill for the same scan. Accelerate generic and biosimilar entry. Let Medicare negotiate where markets fail and publish quality price dashboards people actually use. Tie borrowing to productivity. If we issue debt, it should by capacity. Housing supply, permitting reform, ports and grids that shrink logistics costs. Require an independent productivity score for big bills. Finally, insist on lead time and cohort fairness. Changes should be announced early, with clear tables by birth year and floor protections for the oldest old. If the bill moves, it should move where opportunity grows, not where trust shrinks. The human ledger, stories behind the math. Unknown to them, across town, the math has faces and rent due dates. On one side of a duplex in Milwaukee, Ruth keeps a grocery list in careful block letters. She's 76, widowed, a retired librarian, living on Social Security and a small survivor benefit from her husband's union pension. Her check lands the third Wednesday. The COLA bumped it last year, but eggs and utilities climbed faster. She cuts coupons like it's a sport and keeps the thermostat at 66 because the gas bill scared her in January. When the pharmacy texts a refill, she counts the days until her next deposit and decides whether to split pills for a week. She never calls it that. She says, "I'll make do." Next door, Vanessa and Luis are 33 and 35 with a toddler and a baby who hates naps. Vanessa is a dental hygienist. Luis is a warehouse supervisor. Their paychecks carry Social Security and Medicare every 2 weeks. They don't resent Ruth. She reminds them of their aunt who used to bring tamales on holidays. But when the rent renewal comes, up $120, and daycare says costs will rise this fall, they stare at the spreadsheet on Vanessa's phone. The line they adjust is always the same: their IRA transfers. They promise to catch up when things calm down. Things don't. Meanwhile, in Peoria, James wears a city maintenance jacket that's seen 20 winters. He's 59, shoulders rounded from years of lifting grates and running plows at 3 a.m. His pension brochure looked solid when he signed on. The reality is a system that's 70-something% funded, depending on the year, and the math used. The city council debates whether to raise contributions or delay street repairs. He hears that as higher property taxes and more potholes on his route. He stays late again because there aren't enough hands. At night, he asks his wife whether they should move to the cheaper side of town before he retires. They've lived here 24 years. "We can't sell the memories," she says. He nods and pulls up a pension calculator on his phone. Across the river, Priya is 29 and works customer support for a healthcare software company. She's never had a pension. Her 401k match is decent, but the student loan payment restarted and ate the raise she waited 2 years for. Her parents run a small motel. They're 63 and 65. They don't know what IRMA is, and they will find out 2 years after a good revenue year pushes their modified adjusted gross income just high enough to trigger a Medicare premium surcharge. Priya will be the one to explain it to them at the kitchen table in 2 languages. She'll add a line to her budget labeled Parents. Parallel to them, Darren runs a landscaping business with 7 employees and 2 trucks that always seem to need brakes. He pays both sides of payroll tax for himself and the employer side for his crew. When his accountant shows him a projection for a higher rate, he does math in his head and decides not to hire a full-time 8th hand. He keeps 2 guys on call as contractors for Saturdays. They lose the steadier hours and the employer benefits. He hates that, but the choice is between that and raising prices on customers who already think the mulch is expensive. The spreadsheet wins. It always does. Here's where Dorby touches bone. Elena, 61, is a home health aide in Phoenix. Her back feels every flight of stairs. If the full retirement age rises and she tries to hold on, the last years could be pain. If she claims early, her check locks in lower. She cares for a woman in her 80s who once taught grade school and tells stories about field trips that made kids' eyes light up. Elena laughs and nods and stretches her lower back when she fetches water. She goes home and opens a letter from Social Security, reminding her what she will get at 62, 67, 70. The biggest number feels like a dare. The smallest feels like surrender. Dorby doesn't know about her wrists. Dorsey runs through a grocery aisle in Miami where Emil, 27, shops for his grandmother on Sundays. He picks the canned beans she likes, notices they're a few cents higher, and texts his cousin asking if he can still split the internet bill this month. When the rent rose last year, he took more shifts at the coffee shop on top of his warehouse job. He raised his 401k contribution for 3 months after a podcast told him to max the match, then dropped it to pay for new tires. Inflation isn't a newspaper headline. It's a cart that costs $14 more and the feeling of failure when you do the responsible thing and get punished anyway. Meanwhile, upstate Margaret, 80, lives in a paid-off cape where the roof leaks near the chimney. Her Social Security covers the basics. Her Medicare plan is fine until the doctor says the specialist she needs is out of network and the out-of-pocket calendar resets. Property taxes moved up as assessments caught new sales in the neighborhood. Her son sends $200 a month without telling her he took on an extra Saturday shift to make that happen. He's 52, tired, and telling his 17-year-old they'll look at state schools and scholarships, not the dream list. A younger couple in Seattle, Kai and Jordan, both coders, make good money and still feel fragile. The cap lift hits them. Their rent is high because they chose to be near work, and they don't own yet because the market ran away while they were saving a down payment, and then rates jumped. They look well off on paper. They don't feel in control. They hear friends say, "It'll be fine, Social Security will be there." They nod and increase their Roth contributions while also sending $500 a month to Jordan's mom. whose pension froze years ago and whose cost of living adjustments never quite matched her grocery bills. Then there's the quiet ledger entries nobody sees. A teacher skips a dentist visit because the copay feels like a luxury. A mechanic delays a knee MRI because the deductible resets next month. A clerk declines extra hours because the bump would trigger a benefits cliff or a higher loan payment, and the math doesn't net out. Those aren't news stories. They're how people survive policy. The common thread isn't heroes or villains. It's that numbers are policy and lives are the outcome. Transfers are real. So are limits. A retired bus driver shouldn't be the villain in a story about payroll taxes. A 28-year-old barista shouldn't be a prop in a morality play about thrift. They share a ledger written by laws passed when their grandparents were alive. The moral math comes later. The budget math lands now. What nobody in these stories can do is conjure growth or change demographic curves alone. They can vote, save, show up, help a neighbor, and push their city council to pick realistic assumptions for pensions. They can plan for the doors and keep some dignity in the way they weather them. The rest is the choice we make together about who absorbs what, when, and why, and whether we tell the truth while we do it. The lie and the choice. The promise was never savings in a vault. It was a transfer that's buckling under age and cost, and the bill is coming due. If you want the follow-up on surviving the three doors, and a deeper dive on defending your paycheck, subscribe and watch the next episode now. Share this with someone who still thinks a late-night vote makes the math go away.